Hey guys, welcome back to Smart Wallet and Me. If you guys are new to my channel, consider subscribing and don't forget to hit that notification bell so that you guys can get more videos like this that I put out almost on a daily basis. And also, please don't forget to tear that like button up. Now let's get to it. A lot of people would love to have their own house. Besides, it's considered the American dream. Unfortunately, it has slowly become more of a dream than a reality for a lot of people, as the real estate market has risen over the past 20 years, leaving behind a generation of people who can't afford to buy a house. I came across an article on MSNBC that provides 3 rules to abide by when making a decision to purchase your first home. And these 3 rules are called 30-30-3. The author advises to follow at least one of these rules to provide some sort of financial safety, and all 3 rules if you want to play it extremely safe. So let's get into it and break it down to see how it really works. Rule number 1, spend no more than 30% of your gross income on a monthly mortgage. The traditional industry standards advise that your mortgage should not exceed 30% of your gross income. With interest rates falling to historic lows, it has become tempting to purchase an even more expensive home than you can afford. However, if you can keep this rule in mind, it would benefit you to create a buffer zone of affordability the next time you go shopping for a house. The more income challenged you are, the safer it would be to spend less so that you aren't stretching yourself thin. Rule number 2, have 30% of the home value saved up in cash or equity. So 20% of this amount should be your initial down payment to avoid paying PMI and to get a lower interest rate, and the other 10% should be held in cash as a buffer. When you put a down payment of 20% on your purchase of a home, you are automatically building a 20% equity in that property, and it also gives you peace of mind, and it gives peace of mind to the bank that you aren't going to easily walk away from this deal. You should also reserve 10% of the value of your home in cash to have a larger financial cushion. If you can find a home that is undervalued, then it becomes even more attractive from a buyer's perspective, since you will already gain more equity on your investment. However, this is very difficult to do in the current real estate market. Rule number 3, the price of your home should be no more than 3 times your annual gross income. This is a quick and easy way to screen for homes in an affordable price range. You just take your gross annual income and multiply it by 3, and you get your affordability index. For example, if you earn $100,000 a year, then you can comfortably afford a home up to $300,000. With lower mortgage rates, you can extend the purchase price of your home up to 5 times your annual income depending on your circumstances. Just keep in mind that a larger purchase price means more absolute debt, higher property taxes, and maintenance expenses. For example, in Los Angeles County, as of recording this video, property taxes are 1.25% of your purchase price. The property taxes should be taken into consideration whenever you're making a decision to purchase your home. Let's say, for example, you make $120,000 a year and have saved $100,000 in cash at age 30. That's very good. But you are interested in buying a California home worth $850,000, which is 7 times your annual income. You are already breaking rule number 3. You can't put down 20% as a down payment because 20% of $850,000 is $170,000. Instead, you choose to put down 10%, which is $85,000, leaving you with only $15,000 in cash reserves and a $760,000 mortgage. This is breaking rule number 2. Also, keep in mind that with a lower down payment, you now have to pay private mortgage insurance or PMI, which raises your monthly payment until you can reach an equity of 20% of your loan. Assuming you get a 3.75% interest rate, your monthly payment with PMI would be about $4,830, and after 66 months, your payment would go down to $4,511. Since you make gross $10,000 a month, you shouldn't go over $3,000 a month in your monthly payments. And now you have broken rule number 1. In this scenario, you have broken all 3 rules, making you more vulnerable to financial disaster. Instead, This person should be looking for a home closer to the $360,000 range. In this example, they could put down $72,000 as a down payment and leave them with $28,000 cash. With a higher down payment, you could probably get a better interest rate of, let's say, 3.25%, or probably even lower, with no PMI. So your monthly payments would be $1,711, considerably lower than your $3,000 monthly budget. You could extend your purchase price as long as you keep your monthly payment below 30% of your gross monthly income. So if you raise your purchase price, let's say, to $450,000, you need $90,000 down payment, and your monthly payment would be $2,117 without having to pay PMI. It would be best to avoid overextending your finances and lowering your search criteria to a more affordable price range. The next time you think about buying your next house, think about abiding by these 3 general rules of 30-30-3, and it will serve you well. These rules are not set in stone and should only be used as a general rule to help guide you to make a good financial decision when thinking about buying your next home. And talking about a good rule, don't forget to like that like button and tear it apart. If you like this video, please give it a thumbs up, and please consider subscribing so that YouTube's algorithm can share it with other people like yourself, and it will help my small YouTube channel out. I'll see you guys in the next video. Thanks for watching.